Dr. Martin Patrick, Deepti, Dr. Dhanraj, Shyam Srinivasan, everybody gathered here. Thank you very much for inviting me to give this 12th quarterly lecture at the CPPR. Actually, Dr. Dhanraj has been inviting me to come and speak here for quite some time. We could not find a suitable, mutually convenient date. I'm happy that I've come here today, and I'm come here in the context of my recently released book, Who Moved My Interest Rate, which is about my experiences as the governor of the Reserve Bank. So what I thought I would do is largely speak about the challenges and dilemmas that I confronted as the governor, and then maybe respond to some questions that you might have. Okay. I took office as governor on the 5th of September 2008. Those of you with some memory of recent financial history would note the significance of that date, because on the 7th of September, Countrywide went down. On the 8th of September, Fannie Mae and Freddie Mac were taken over by the US government. 10th of September, AIG, the largest insurance company in the world, came to the brink of a meltdown. 12th of September, the crisis spread to retail banks. Washington Mutual and Wachovia came under pressure. 13th September, Merrill Lynch vanished, and 16th of September, Lehman Brothers collapsed, plunging the global financial sector into a near-death experience. Those were my very early days in the first few weeks of my tenure as governor. I used to travel quite a lot at that time, and wherever I went, people used to ask me, media, etc., and researchers such as people at the CPPR, so when will the crisis end? As if I knew. But then the story going around at that time was that this new governor has come and has brought on the crisis. So I used to say, okay, if I brought on the crisis will end when my term is over. And I used to tell them when my term would be over. I took all that criticism in my stride. I played along with that. And then, here's the thing. The week after I left the Reserve Bank in September 2013, the crisis ended. Okay, the economy got back on track, the rupee stabilized, growth started trending up, inflation started trending down. So there was one prophecy on which I wish I had been wrong. It was that, but that is not to be my legacy. As the crisis engulfed the world, engulfed India, I was plunged into crisis management even as I was on a very steep learning curve. I was challenged, my leadership was tested, and literally baptism by fire. But it was more than actually baptism by fire, because all the 5 years that I was there was one crisis after another. 2008-9 was the global financial crisis. We recovered from the crisis fairly soon, in fact sooner than most other countries, including other emerging economies. But we were caught up in managing very high, stubborn, persistent inflation, decade-high inflation, which remained high for over 2.5 years. And as we thought inflation was coming down, in the final year of my tenure in 2012-13, I had to manage the exchange rate crisis when the rupee came under pressure as a consequence of the taper tantrums. The Chinese have a saying, may you live in interesting times. I can't complain on that account, because I had very interesting times, in fact, more than my share of interesting times at some times. So what I'm going to do is not talk about all the challenges and all the dilemmas, but I'm going to talk about some of the challenges, or at least one challenge in each of these phases: the global financial crisis in 2008-10, managing monetary policy during the inflation of 2010-12, and managing the exchange rate crisis or pressure during 2013. So I'm moving on to the first issue, which is managing the global financial crisis. When Lehman Brothers collapsed on September 16, 2008, It was a very frightening situation. Frightening situation around the world, frightening situation for us in India. What started as a bubble in the housing sector of America first became a global banking crisis, then a global financial crisis, and then a global economic crisis. Virtually every big name financial institution in the world was engulfed by rumors of imminent collapse. Storied institutions were falling every day. Trading had come to a complete halt. There's fear, panic, anxiety in financial markets. No one, literally no one knew where the financial sector was headed. This is a globalizing world. In a globalizing world, every country is affected. No matter what happens anywhere, it affects countries everywhere. India too was affected. Our financial markets, our equity market, our bond market, our currency market, our debt market, all of them came under pressure. And we used to hear stories at that time about runs on some banks. Even if there were 10 people standing in front of a bank, there was fear that there could be a run on that bank. So it could be Kochi, it could be Indore, it could be Coimbatore, it could be Ludhiana, but there was fear that there could be run on some banks. In India at large, and particularly in the Reserve Bank, there was dismay, there was disbelief, and there was denial about why India should be affected by the crisis. And the reason was, people said there was the Asian crisis in 97-98. This global financial crisis came in 2007-8, after about 10 years. So the question was, India was not affected by the Asian crisis in 97-98. How come we could be affected by the global financial crisis of 2007-8? The reason we were affected by the global financial crisis, even though we were not affected by the Asian crisis, is between 97-98, the year of the Asian crisis, and 2007-8, the year of the global financial crisis, India had integrated into the world, both by way of trade and by way of finance. It took some time for everyone, particularly staff in the RBI, to realize that this was a crisis that was affecting India too, and where to take action. So we did a lot of things in those times. Our main concern was to keep our financial markets functioning, douse the system with liquidity, as much of rupee and foreign exchange liquidity, and maintain flow of credit. Banks were stopping lending, so we wanted them to continue to lend. At that time, we used to encourage, pressurize, and mentor banks to lend. There were many challenges during that time. I've written about them in my book. I'm going to talk only about one. That challenge was, how do I, as a fresher governor, just weeks into my job, manage this crisis, which is the deepest since the Great Depression, most complex, most difficult, most devastating. Imagine the situation. I was just 10 days old when Lehman Brothers collapsed. I was the first governor to have demitted office in Delhi at 5 p.m. the previous day and taken over as governor at 11 a.m. the following day in less than 24 hours. There were finance secretaries who became governors before me, but I was the first serving finance secretary to have been posted as governor. In less than 24 hours, I moved from Delhi to Mumbai. I was an unknown as finance secretary. When I became governor, I became a known unknown. And people, the markets, the banks need to understand the governor, the way he speaks, his stance, his body language, etc. Because they need to interpret what he's saying. But that takes time. It takes about 6 months' time for the markets, the media, to understand the governor, and for the governor to understand the media. But that time was denied to us because during the crisis time I had to communicate, and the media was, the the markets, media, everybody was nervous about whether this guy who's just come, is a fresh governor, is a fresher, can he handle this crisis? Now, that would have been bad enough. But what is worse is that the story going around at that time was that I was sent by the government from Delhi to Mumbai to the Reserve Bank to take instructions from the government and implement them from within the Reserve Bank. This, you must see this in the context of the situation at that time. Dr. Reddy, my predecessor, had established a formidable reputation for maintaining, preserving, and standing firmly with the government for the Reserve Bank's autonomy. So the story was that the government sent Subbarao as governors because he would be pliable. That would have been a difficult impression to live down. It would take some time. I knew that I cannot shout from rooftops that I'm going to act independently. That would inevitably take time. But in a crisis time, that was very damaging. That we had to do a number of things, and the markets don't trust that the governor is acting and taking decisions in what he believes is the best public interest. But on the other hand, thinks that is listening to instructions from other people and implementing them. That was that would have hurt credibility. That was bad enough. But what made it even worse was that I had to act very closely with the government because this is crisis time. Everywhere around the world, central banks like the Reserve Bank of India were working very closely with their respective governments. But the story in India was that no, this new governor has come, he's changed the pattern of working of the Reserve Bank. He's surrendered the autonomy to the government. Okay, now what's the next problem? That would have been bad enough, but what made it even worse was that my staff within the Reserve Bank, they too were not sure about my credentials because they too did not know me. So for them also, whenever I said we will do something, the question was, is the governor saying this because he believes this needs to be done or because he's got instructions from the government? My style of leadership is actually quite collegial, so I would used to encourage our staff to debate issues with me, talk to me about the possible pros and cons of any proposal. I did that even during the crisis. They would never tell the governor this cannot be done. Okay? In India, we don't do that. But I could see that they were hesitant about any proposal that I would raise or any final decision I took. So, and during the crisis time, we did some unconventional things. Like, for example, we established a line of credit for mutual funds and for non-bank finance companies. In the Reserve Bank, this was never done. But during the crisis time, this had to be done. Within the Reserve Bank, there were reservations about whether this can be done, whether the governor is saying we should do this because he believes that they must be done or because the government is telling him to do all this. Anyway, the story I'm trying to convey to you is that in the first few weeks and in the first few months after I took over as governor, several circumstances complicated crisis management. Those circumstances were unique to the Reserve Bank, were unique to me. It's a matter of enormous satisfaction to me that in the 100-day evaluation of my governorship, which came around early December, the general consensus or verdict written in the media was that I handled a very turbulent period with intelligence, professional integrity, and exemplary calm. By the time I finished my tenure in 2013, not only had I gained the confidence of the entire RBI family as someone who would do what is right, but also as someone who would stand up for RBI's autonomy firmly, fiercely, and boldly. Okay. So that's about the crisis. I want to move on and talk about the second phase of this entire 5-year crisis period, which is the high inflation period that I told you about. As I told you, we had high inflation starting 2009, which continued up until 2012. Inflation is bad at all times. What complicated matters during that period was that growth also started moderating. Normally, you would, when you have high inflation, you normally have high growth, or other way around actually. When your growth is accelerating, typically you might have high inflation. You need not, but you might. What is difficult to explain is a period when your growth is moderating and your inflation is increasing. That's a very difficult combination to have, very toxic. Managing this tension between growth and inflation is a challenge. It's a challenge because to support growth, the Reserve Bank needs to maintain a soft interest rate regime. On the other hand, to rein in inflation, control inflation, the Reserve Bank has to maintain a tight interest rate regime. So with one instrument, just the policy interest rate, how does the Reserve Bank balance this tension between growth and inflation? This tension was not unique to me. It's not unique to the Reserve Bank. It's not unique to India. It's not unique to our time. This tension is there for all central banks, in all countries, for all times. What is unique to me, though, is what I told you earlier, which is that we had a very sharp tension of growth moderating steeply and inflation being persistent. Let me illustrate to you the challenge of managing this tension. In 2009-10, the Reserve Bank was celebrating the Platinum Jubilee of the bank, because the Reserve Bank was set up in 1935. So 2009-10 we were celebrating the Platinum Jubilee. There were a number of events planned across the country as part of the Platinum Jubilee. One of the events was a town hall meeting in Chennai on the steps of the Egmore Museum. It was a nationally televised show. I, as governor, and all our 4 deputy governors, we were there, and some TV channel was conducting the show. There was a moderator. There were about 300 people. This was in early January, just before Pongal. Chennai was in a celebratory mood. Reserve Bank was in a celebratory mood. 7 p.m. on the steps of the Egmore Museum. It was really like a festive occasion. There were about 300 people in the town hall meeting. They were literally taken off the street. Middle-class people, young people, some older people, low-income people, middle-income people, and we fielded questions from them, and the questions were predictable. People said, we don't get loans from banks. Banks charge very high interest rates, and some people complained that they don't get high enough interest rate when they deposit money. People complain about services in banks. They complained about ATMs. They complained about not getting education loans. They complained about not being able to take foreign exchanges when they travel outside. All sorts of predictable complaints. Right about half an hour into the show, on the spur of the moment, I just took a poll. I said, okay, how many of you want the Reserve Bank to prioritize growth over inflation? About half the hands went up. And then I said, how many of you want the Reserve Bank to prioritize inflation over growth? About half the hands went up, half and half. That there was nothing dramatic about that. Then it struck me, just by a visual impression of the hands that went up, that people who wanted the Reserve Bank to prioritize inflation over growth were the middle-aged people, middle-class people, low-income people who were hurt by inflation. Families who had to manage family budget. When their incomes are fixed and prices go up, they were finding it difficult to make ends meet. People who wanted the Reserve Bank to prioritize growth over inflation were the youngsters, young professionals who were in the 25-35 age group, because they were concerned about jobs, they were concerned about their career prospects, and they obviously had a longer time horizon. So the message we got at that time, and the message that remained with me, is that there are different constituencies in our society who prioritize different things. How does the Reserve Bank meet these conflicting priorities? I went to Chandigarh once and I met with the Pensioners Association. When you meet with the Pensioners Association, what you can predict what they would ask. You know what? Right? The interest rate that banks give is very low, because for pensioners, the only source of income is their pension. For most people, the source of income is their pension, and the only thing they do is either keep that in a fixed deposit or a savings account. They keep their savings in a fixed deposit, and they keep some running income in their savings account. And they say, sir, banks are giving very low interest rate. Okay. Then my next meeting was with the Chandigarh Small and Medium Enterprises Association, SME. And what would they ask? They say, sir, interest rates are very high. Banks are charging very high when we go to take a loan. So again, different constituencies. Pensioners want something. People who have fixed incomes want something. And borrowers want a different thing. And people actually want different things when they talk about different things. You know, even middle class people, when they want to take an education loan for their child or daughter, they want a low interest rate. But when they want a fixed deposit, they want to maintain care, they want a high interest rate. The point I'm trying to convey to you is that there are different constituencies across our society who have different priorities. For the Reserve Bank, the challenge is, how do you harmonize the interests of these different communities? During that 2.5 year period when we were fighting inflation, I was criticized by hawks. Hawks are people who want to contain inflation with heavy-handed policy. And I was criticized by doves. Doves are people who want growth to be supported by maintaining a softer interest rate policy. So I was criticized by hawks for not being hawkish enough. I was criticized by doves for not being dovish enough. I don't want to lead a defense of what we did or we did not do, but let me give you some flavor of the criticism. From those who said I did not fight inflation sternly, firmly, the complaint was that I raised interest rates in very small steps of 25 basis points, baby steps they were called, and I earned a moniker of Baby Steps Subbaraw. That those 25 basis point increases in interest rates were too mild, too small, given the ferocity of the inflation that we were confronting at that time. Why was the Reserve Bank not more aggressive? Why did we not raise interest rates by 50 basis points or 75 basis points as these people wanted, these critics wanted? That is because we were also looking at growth. And growth, the numbers were telling us that recovery was not complete. Growth was still not picking up. So even as we were fighting inflation, we also had to support growth. And then around the world, the global financial crisis was still on. The Eurozone sovereign debt crisis was brewing. There was concern, anxiety, fear in global financial markets, and we could not afford to raise interest rates very high. So we were struggling between concerns of financial stability, concerns of growth, and concerns of inflation. That struggle was of an entirely different magnitude and complexity than the struggle during the current time or before my time. What about the criticism from the other side? That I raised interest rates so aggressively that I killed growth. In fact, one of the magazines had my picture on the cover and had the story, "Is this man killing India's growth?" That was the banner on the magazine cover. Why did these people want us to maintain a low interest rate regime? They said, by raising interest rates, the Reserve Bank is killing investment. Investors want low interest rates, right? So that they could borrow and invest. By raising interest rates, the Reserve Bank was killing investment. Our story at that time was that no, interest rate is not a constraint now. There were other factors that are discouraging investors from investment. Interest rate might become a constraint, but that's not the constraint now. You know, today Deepti talked about the policy that Governor Rajan had unveiled this morning, right? The policy formulation process in the Reserve Bank actually starts about 2 weeks before the date. We consult various stakeholders, consult banks, non-bank finance companies, we consult financial markets, we consult economists, we consult corporates, consult industry associations, etc. I had ahead of one policy meeting about 20 corporate leaders from the country in meeting in the Reserve Bank. These are 20 of the largest corporates in the country. And you can expect their plea. When they come to the governor, these corporates invariably say, "Sir, please cut the interest rate, it's too high." I said, okay. I asked them, all right, I want us to cut interest rates. I'll certainly consider your plea. But if we actually cut interest rates, how many of you are going to make an investment decision in the next 3 months? Not one hand went up. Okay. So to believe that investment was being inhibited because of the Reserve Bank's interest rate was wrong. In any case, I don't want to use this platform to defend that record, but it was a dilemma for us to manage this tension between growth and inflation. The third segment of the challenges and dilemmas is managing the exchange rate during 2013, when the rupee depreciated by about 17%. Because of taper tantrums. What were the taper tantrums? I don't know how many of you understand, but because of the crisis, global financial crisis, America, Europe, Japan, the UK, they had all launched quantitative easing. You don't have to understand all the details of that. Consequently, a lot of capital came into our country. And when Chairman Ben Bernanke, chairman of the US Federal Reserve, said that we are going to withdraw that quantitative easing, he said that in May 2013, the currencies of emerging markets went for a spin, including the rupee. In India, there was a carnage in our external sector. The rupee depreciated by about 17% between May, when Chairman Bernanke made that statement, and August. In a matter of 4 months, the rupee depreciated by 17%. India was part of the Fragile Five, one of those countries in the Fragile Five. The Fragile Five countries at that time were Indonesia, Brazil, Turkey, South Africa, and of course India. Why was India bruised so badly by the taper tantrums? Was in fact a massive correction in the exchange rate inevitable? Those are questions that I've addressed in the book. I don't want to talk about them now. All I want to say here was that managing the exchange rate, which went into a tailspin because of the taper announcement by Chairman Bernanke, was a big challenge for us in the Reserve Bank, a big challenge for me as the governor. And the last 1 year of my tenure as governor was actually consumed by mounting a massive defense of the exchange rate. There were many challenges at that time. I don't want to talk about all of them. There's only one challenge I want to talk about, which is how does the Reserve Bank predict market reaction? Now, everything that the Reserve Bank does depends on how the markets respond to that policy. If today Governor Rajan kept the interest rates unchanged, the effectiveness of that policy depends on how the market responds to that policy stance. How people's expectations change. That's true of everything that a central bank does, whether it's managing inflation, managing the exchange rate, or managing your savings behavior, etc. Predicting people's expectations, predicting market response is a very difficult thing, even during normal times. It can be extremely complex and very compellingly difficult during crisis times. Let me give you some examples. You are all aware that all of you can take out some foreign exchange outside the country and invest. Every individual in India, it was allowed at that time, I'm talking about 2013, was allowed to take out $200,000 per year for investment abroad. You can do that. You can take out $200,000 to buy houses or buy property or invest in equity, whatever. Companies, corporates also can take out money. Okay, that's the Reserve Bank's facility or rule governing how much individuals and corporates can take out under what is called a liberalized remittance scheme. This is quite different from the money you take out when you travel for a holiday outside, or when you send your daughter or son for education. That's a different matter. Or you go for medical treatment outside the country, you need foreign exchange. That's different. In addition to that, every individual in the country, if she or he chooses, could take out $200,000. What we did on August 14, 2013 was actually reduce the ceilings. How much individuals can take out, how much corporates can take out. Why did we do that? We did that because we wanted to see that capital remained within the country in order to defend the exchange rate, which was moving with a lot of volatility at that time. The market reaction was swift and brutal when we did that reduction. The rupee fell by about 3% in less than 4 hours. That's a very, very significant depreciation. In less than 4 hours, in less than half a day, in just about half a day, rupee fell by about 3%. This is not the first time that the Reserve Bank had imposed capital controls. Historically, whenever there was pressure on the exchange rate, whenever exchange rate was volatile, the Reserve Bank had been using capital controls. Why did the market behave in such an unexpected manner to this policy move on August 14, 2013? It was a puzzle for us, it was a puzzle for the markets as well. The surmise was that markets reacted like this because historically, traditionally, whenever there was an exchange rate problem, the Reserve Bank restricted inflows. This is the first time we were restricting outflows, perhaps. And not that very many people, there were no millions of people taking $200,000. There were very few people. But everybody saw this as the Reserve Bank communicating the size of the crisis, that they saw this as panic on the part of the Reserve Bank, and the markets reacted the way they did. Okay. Let me give you another example. In July 2013, during the taper tantrums, I raised the interest rate by 50 basis points outside of a policy. On July 15, there was no regularly scheduled policy. We raised interest rates, policy interest rate, by 50 basis points. Why did we do that? We did that because we were getting market intelligence that there was too much liquidity in the system, and the speculators were playing around with that. With all the rupee liquidity, they were betting on the rupee. They were betting on the rupee in foreign markets, in Dubai and in Singapore. They're called non-deliverable forward markets. You don't have to understand all that, but the point is that there was a lot of liquidity in the system, because of which the exchange rate, there was a lot of speculation on the exchange rate. So we wanted to withdraw that liquidity so as to control volatility in the exchange rate. My expectation also was that, this is a very unusual move, as I told you. My expectation was that by taking this unusual move, we would communicate to the markets and to the larger public that the Reserve Bank is determined to defend the exchange rate. Okay. But many of you may not remember, but 2013 was also a time when our growth was moderating steeply. So the TV channels that night and the newspapers the following morning, people commented on this unusual move by the Reserve Bank. There was also commentary on whether this policy, this extraordinary, unusual policy of tightening interest rate by the Reserve Bank, might hurt growth. So there was a media conference the following day. So July 15, we did this hike in interest rate. And the night TV channels, the morning newspapers played up the policy. They talked about whether this would hurt growth. And later that day, there was a press conference. I expected the first question. And of course, predictably, the first question was, sir, is this tightening of interest rate that you did yesterday, is it not going to hurt growth? So having seen the TV channels, commentators, analysts talking about how this policy might hurt growth, I thought it advisable to assuage the market's concern and say that yes, the Reserve Bank is sensitive to growth concerns. However, we had to do this extraordinary policy measure of raising interest rates in order to defend the exchange rate. We will withdraw this measure as soon as possible. We will not continue this measure beyond the minimum time necessary. What I said was what everybody in the newspapers, commentators and analysts said. What I said was also what we wrote in the policy statement. But the market reaction was unsparing. The rupee fell from, I don't remember the exact numbers, but again it fell by about 5% in just half a day. Why did the market react like that? You shouldn't have, right? Because I said what we wrote in the policy. And I said what commentators and analysts had said. There was nothing surprising in what I said. But the surmise was that the market expected the governor to say that we are focused, our undivided focus and attention is on managing the exchange rate and not spoken about growth at all. So that you convey very firmly, very assertively that you are focused completely on the exchange rate. By muffling this communication between growth and exchange rate, I fumbled, or I was criticized as having fumbled. The second criticism against that was that I sounded very hesitant, apologetic about defending the exchange rate, because I also sounded concerned about growth. So I asked some people, what should I have said to not sound apologetic? They said, instead of saying that we will withdraw this measure as soon as the rupee stabilizes, you should have said, you will not withdraw this measure until the rupee stabilizes. Say it more assertively rather than say we will withdraw this measure. You say we will not withdraw this measure until the rupee stabilizes. People also said that the governor was not alpha male enough. I don't know how many of you heard that phrase, alpha male. So I looked up, I Googled and said, what's an alpha male? And if you Google an alpha male, it's very confusing. What are the attributes of an alpha male? Okay. So I was unclear whether not being alpha male enough was a badge of honor or a certificate of weakness. Okay. In any case, I let the matter rest there. But this communication gaffes, where governors say something and the markets react in a wild manner, in a completely unexpected manner, was not unique to me. It happened to virtually every governor, particularly during the crisis time, even to some of the veteran governors. I just told you about Chairman Bernanke. When he made that taper tantrum statement in May 2013, he did not expect that the global financial markets, especially markets in emerging economies, would behave the way they did. In fact, he wrote a book that was published even before my book, and he writes in that I was completely baffled by how the markets reacted. Today is the 9th of August, right? On 14th of August last year, the People's Bank of China adjusted their exchange rate. They said we are readjusting the peg or some language they used. But in their statement, they explained why they were adjusting the peg, because they wanted to make the yuan exchange rate more market aligned. They said in very plain English why they were adjusting that. But around the world, what the People's Bank of China, which is the counterpart of the Reserve Bank of India, what they said was not believed. Markets said, no, there must be some other motive why China did this, and there was very wild reaction. All of you might remember last year, right? So everywhere around the world, every central bank governor, even some of the veteran central bank governors, have had communication problems. So I spoke to you so far about my challenges, the challenges and dilemmas I confronted, managing the crisis in 2008-10, managing monetary policy during a period of high inflation and decelerating growth, and managing the exchange rate. The last thing I want to say is keep your ear close to the ground. There's a chapter in my book, Keep Your Ear Close to the Ground. When I was appointed governor in 2008, I went to call on Prime Minister Manmohan Singh. Dr. Manmohan Singh himself was governor of the Reserve Bank in the early 80s. So I went to see him in his South Block office for about 15 minutes. I met him, we talked about things. He said, we have great confidence in you, that's why we appointed you as the governor. All that was okay. And then I said, okay, so I'll take leave. And he walked me to the door, and just as the doorstep, he put his hand on my shoulder and said, there's one thing I want to tell you. I don't normally advise people, but there's one advice I want to give you, which is this. You've been an IAS officer, you've been a civil servant for 35 years. I've seen you, I've known you, but now you're going as governor. When you go to the Reserve Bank, you will run the risk of losing touch with what's happening in the country. In your preoccupation with numbers like credit growth, inflation rate, interest rate, money supply, you will forget that there are real people behind these numbers. Don't get lost in those numbers. Remember the faces behind those numbers. Think how every action of you as the governor affects people's everyday lives. In the 5 years that I spent at the Reserve Bank, I've tried to follow the Prime Minister's counsel to the best of my ability. Okay. So finally, why did I write the book? I, what I spoke to you about the global financial crisis, managing inflation, managing the exchange rate, they're part of the book, but they're only a small part. And the book covers a fairly wide canvas, my experiences as the governor. First, of course, I wrote the book in order to communicate all those challenges and dilemmas. The second reason I wrote the book was to demystify the Reserve Bank. The reason I believe the Reserve Bank has to be demystified is that the Reserve Bank makes decisions on interest rates, on bank regulation, on payment systems, on a number of other things. People don't understand the connection between what the Reserve Bank does and their everyday lives. What the Reserve Bank does impacts the prices you pay in the market, the interest that you get on your savings bank account, the interest that you get on your fixed deposit, the interest that you pay if you take a housing loan. As I said earlier, how much foreign exchange you can take out for what purpose. All these are determined by what the Reserve Bank does. But people don't understand the connection. Today, Governor Rajan kept interest rates flat, did not change them. How many people understand the connection between that and their lives? I wanted to demystify the Reserve Bank and make people understand that connection so that you hold the Reserve Bank accountable. There's another reason why I wanted to demystify the Reserve Bank. The image of the Reserve Bank among the larger public is negative. There's a negative stereotype that there's one big tower office in Mumbai. Those people who work there, they have a tunnel vision. They are rigid, unbending, don't understand the realities of India. They make policies and don't care what happens. This is not true, but that's the negative stereotype image of the Reserve Bank. You know, when I was sub-collector 40 years ago, when I first joined the IAS, my first posting was as sub-collector in a place called Parvatipuram in Srikakulam district in north coastal Andhra Pradesh. I'm talking about the mid-70s. That was the time Srikakulam district in Andhra Pradesh was the first region outside of Naxalbari in West Bengal to have been affected or to be impacted by the Naxalite movement. It was the first region outside of West Bengal to have been impacted by the Naxalite movement. So when I went there as sub-collector in the mid-70s, the extremist influence was on the wane, but our task at that time was to improve the livelihood of the tribal families who came under the sway of this extremist influence. Why were these tribal families more susceptible, more vulnerable to extremist influence? Because they are under the clutches of landlords, under the clutches of money lenders. Many of them have borrowed money, they were unable to repay, they lost their land, they became bonded labor. So they were vulnerable to this extremist influence. Our task in district administration at that time was to improve their livelihood so that they would not be susceptible to such influence. In fact, at that time, I don't know, I'm talking about 40 years ago, if you ask the tribal families their enemy number one, you can't guess, where's the forest guard? The forest guard was their enemy number one. Enemy number two was the policeman. Okay? And the Reserve Bank came close to being enemy number three. Okay? And I'll tell you why. They did not get any loans from banks and all that. And I, as sub-collector, to see that tribal livelihoods improved, used to go from one bank branch to another, urging bank managers to sanction loans to tribals. And bank managers are understandably wary of lending, especially to low-income tribal households. and that they would do appraisal, they would do all sorts of things, but after all that, the net result is that there is no loan. They'll give all sorts of excuses. When all excuses fail, the final Brahmastra is, sir, we can't give loans because the Reserve Bank regulations don't permit. Okay? There is no Reserve Bank regulation that does not permit lending for anything, particularly lending to tribals. But out of the Brahmastra, you can't say anything, no, the Reserve Bank regulation does not permit. In fact, one MLA at that time, he was campaigning for re-election. He said in some speech that if I'm elected, our government will fight for the abolition of the Reserve Bank of India. Okay? So that was the type of negative image. It's not that the Reserve Bank did anything to deny loans to tribals. That was the story going around. So I thought I must demystify the Reserve Bank to convey the correct impression about what is there. So those were the two motivations for my book. There's been a lot of media coverage on the book, and much of that, indeed, almost all of that has been about my differences as governor with the finance ministers, Mr. Chidambaram and Mr. Pranab Mukherjee. Yes, I wrote about those differences, but that's only a small part of my book. Much of the book is about all the struggles that I went through. It is also an attempt to convey the challenges in making public policy. In public policy, there's no black and white. It's always gray. You can't say, you can't tick one box and say, this is what I want to do. So I wanted to convey those challenges. Okay. So thank you very much for listening to me, and thank you for inviting me to speak in Kochi. I enjoyed coming here. I enjoyed talking to you. Thank you.